time to review the year. And what a year it's been. Let's take a look at some facts of the case here of what has been an extraordinary year. So just to kick off, this is quite a complicated chart. It shows you returns of pretty much all asset classes for the last, 15 years. And towards the right there, you can see 2025. This is not quite the full year yet, but nearly there. Gold, 2025, top right there, you can see 55% return. Very strong year for gold. EFI stocks, which is all the stocks outside America, up 28%. Emerging market stocks up 25%. And then the US up about 15, 20, 25% if it's the NASDAQ. And then down towards the bottom, you can see Bitcoin has been pretty much flat, actually down a little bit as we speak over the year. A little disappointing in that asset class. And then bonds kind of low single digits there. So actually overall, pretty good year for investors, it must be said. So we should recognize that despite all of the volatility. But the headline is that gold and non-US markets won the year. And if you look at the backdrop to that, this is the market capitalization of the 10 largest US companies as a percentage of the 500 largest overall. And you can see that it is a very concentrated market. It's all around AI and tech. 2025, the top 10 companies in America are almost 40% of the market. That's pretty much a record high. We can talk about that in a moment, but that tends to imply a little bit too much concentration, if you like, in quite a few names in terms of market leadership. And it's all about tech. This is the tech sector against mid-cap stocks, or what you might call the real economy. And you can see this is in kind of 5-year chunks back to 2005. It's the tech sector in white. It's the real economy in red. And you can see they kind of match each other through time until 2020, really. And the last decade has been all about tech. The white line just took off, and the real economy has been pretty flat, really, for the decade in terms of stock market returns. And then you can look at it against something like energy. I mean, we know that artificial intelligence and these huge data centers require enormous amounts of energy, and yet the energy sector, as a proportion of the market, is at an all-time low, 4% of the market, whereas tech, again, is 36% of the market. So that's an interesting thing for investors to ponder in terms of the attractiveness of each of those sectors. And if you look at where the returns have come from, really since the launch of ChatGPT, that's a seminal moment in history. November 2022, you can see in the middle of this chart, contributions to S&P 500 since November 2022. And the first column is AI direct stocks. That's the interesting column. And the percentage of S&P returns since the launch of ChatGPT. So price returns, 75% of S&P 500 returns since the launch of ChatGPT have been AI stocks, 80% of earnings growth, 60% of EBIT growth, that's another measure of profit, and CapEx growth and R&D growth, 90%. So it's been all about AI since the launch of ChatGPT in terms of market returns. And it's all about data centers. This gives a useful snapshot, I think, of the data centers globally. There's about 10,000 data centers in the world, around half are in America or the Americas. About the other half is split between Europe and Asia. And they consume, obviously, an enormous amount of power and an enormous amount of capital expenditure. And so what are you finding with the certainly the hyperscalers amongst the Mag 7? So Meta, that's Facebook, Alphabet, that's Google, Amazon, and Microsoft in this chart. They'll be spending almost $1 trillion next year just on data centers to produce the large language models which power the AI, which is changing and certainly will change all our lives. But it's a very different profile for these technology companies. They used to be tech light, or CapEx light, I should say. Now they're CapEx heavy. Very different model, and they need to make returns on that CapEx to be good stock market investments in the longer term. And in terms of the broader economy, this is US construction spending. Again, it's all about AI. The yellow line at the bottom there is data centers we've been talking about. Office buildings in the middle in blue, and then the top red is electric power. So lots of construction spending going into electric power. Office buildings coming down, workers at home, and data centers going up. So there's more money spent on data centers now in America, give or take, than office buildings in terms of new construction. And that's reflected in the split between capital and labor. This is an interesting chart. It shows software and information processing equipment investment. So CapEx into data centers, effectively, what we've been talking about just now. That's the gray line, and you can see that CapEx in data centers has exploded. At the same time, demand for labor in green has fallen. So you're seeing already the shift from labor to capital when it comes to the influence of AI. And in the broader economy, again, this time in America, this is real GDP excluding the CapEx on AI. And real GDP was pretty much flat in the first half of 2025 and could well be the same for the second half when the numbers come out. It's all about AI in terms of economic growth, CapEx, and stock market returns. And there are some risks, of course, in these AI valuations. This is an interesting chart if you can decipher it. We're getting a lot of cross-shareholdings going on and circular financing deals. So one example out of this chart, NVIDIA is at the core of this, and NVIDIA announced a deal to invest $100 billion into OpenAI, Sam Altman's vehicle, which does ChatGPT. So NVIDIA invested $100 billion into OpenAI, and in return, OpenAI invested $100 billion into NVIDIA chips. So that kind of circular financing is happening across the AI ecosystem. That's a little bit concerning in terms of how this whole thing's actually going to be funded, because the circular funding is money really from, if you like, nowhere in terms of that chip provision. Interesting conversation here. You can see from the left, Mark Zuckerberg, Elon Musk, Jensen Huang, Pendar Sisha from Google, Tim Cook, Sam Altman, and Jeff Bezos in a car park with lots of very fancy cars, including a Cybertruck, talking about the future of humanity and the future of AI, no doubt. Except that this is, of course, a deepfake. This is AI generated. They did not meet in the car park. And this is the kind of thing we're going to have to get used to now in terms of the way we live our lives and what we can trust and what we cannot trust online. So the backdrop in the wider economy to how markets have done well in 2025. And it's a lot to do with liquidity in the markets. AI, absolutely, but also liquidity going into equity markets still and driving them higher, along with gold, as we've talked about already. This chart shows you the interest rate reductions versus the interest rate increases. So the brown piece at the bottom are cuts in interest rates. The green at the top are increases in interest rates. And the black line is the net effect. So to put it simply, rates were cut into COVID aggressively. They've been increased post-COVID as inflation came through, and now they've been cut aggressively, particularly in 2025. This is a global chart. So interest rates globally have been coming down, including the US, and that provides a lot more liquidity into the economy and into the market. And that's been driving markets higher, as well as driving consumer spending, particularly in the US. Well, if you take the US economy, it's give or take $30 trillion, of which 2/3 is consumer spending. So that's $20 trillion of consumer spending in the United States, which is 20% of world GDP. So $1 in $5 spent globally is spent by a US consumer. Massive engine of growth. And that's been just really exploding post-COVID. Partly COVID checks, partly stimulus into the economy, partly money printing. I've talked about the $30 trillion of money printing we've seen really since COVID and since the GFC. That's 30% of 30% of world GDP. And that's driven consumer spending in America. It seems to be topping out now, but that's been a very powerful force for the economy and for the market, particularly in 2025. As well as the balance sheet of US consumers, this shows you the equity valuation of housing in America versus the debt attached to that housing. And you can see the black line, which is the equity, has again exploded. US house prices have gone up a lot since 2010, since the GFC, global financial crisis. They've pretty much doubled over that period, whilst the debt, of course, hasn't doubled. And so the net effect is that US consumers feel very flush with cash and spending and, again, investing in the stock market. But is there too much money in the market? I've talked about this quite a lot. There's a lot of money still sloshing around the world economy, a lot of money printing. In simple terms, too many dollars in the economy. And that's come through in inflation. A couple of years ago, inflation was running at about 9% in America. It's now down to 2-3%. The question is whether it'll start to go up again. That happened in the 1970s, which is the blue line in this chart. We had an initial inflation surge, came down, and then we had a second larger inflation surge. And it's a question as to whether the same pattern will repeat now. If inflation does start going up, then that's a risk really for the market. The markets do not like inflation. And inflation is proving a little sticky on the way down, as I was talking about really for the last couple of years. It's not at 2%, it's not below 2%. It's more like the 3% number in Western economies. And that's been very painful. And this shows cumulative CPI inflation since January 2021. And you can see that kind of 8 to 9% effect per annum. Prices in the UK are up about 30%. United States prices are up about 25%. The euro area is up 23%. China prices are only up 2.8%. And so competitively, China is even more competitive today than it was previously. And that's very painful for consumers in, again, quote unquote, Western markets. And we're seeing that coming through in political pressure on incumbent governments. And also interest payments have gone up. We've talked about the US interest payments, $1.2 trillion per annum, $100 billion a month in interest payments alone on the debt. There's too much debt in Western governments. This shows you it's a global trend. So $2.7 trillion of interest payments per annum are being paid by governments globally. And that is going up. So again, debt is a little too high for comfort. So in terms of the markets generally, are they cheap, expensive? They're probably not cheap, particularly in the US. I've been talking about the shift from the US into other markets, which are cheaper. The US does not look that cheap. Non-US markets look much better value. This shows you the US market, price to sales. It's at its kind of peaks, same as it would have been at previous peaks. So that's a little bit of a concern. And this shows you kind of a composite, again, of the US, of the price earnings ratio, the forward PE, the price to book, price to sales, etc. That's a composite measure, quite interesting, back to the 1929 peak before the great crash and depression, 1999 peak. We're back at those peaks again. So we've got lots of growth within certainly the AI sector in America, but markets are discounting quite a lot of that, particularly in America, better value elsewhere. And one point to note within the market, which is driving things, this shows something which people don't often focus on. This is net flows into passive funds and active funds. So passive funds are indexation funds. Active funds are active managers trying to outperform the benchmark. Passive flows are in black. Active flows are in blue. And you can see there have been massive flows away from active fund managers into passive indexation products, which just buy the whole market. And that's kind of fine, but it gets to a point where passive flows become dominant, and that's happening now. So there are more assets invested in passive strategies than in active strategies for the first time. This again is a US stat where we have these stats in the richness we need. And you can see the passive exceeds active now. What that means is that when you put money into an indexation fund in a concentrated market where the large shares are a big part of the market, then a big part of your money goes into those big shares. And that tends to push the larger companies' valuations up even further. So you get passive money chasing these highly valued shares, which are a very concentrated part of the market. And so that liquidity gets channeled into the big names, the Mag 7, over and over and over again. So that again can lead to some danger in terms of the concentration of the market and the valuation of the market itself. So those are equities. A good year for equities generally, particularly outside the US. These are crypto. This is Bitcoin and Ethereum. It's been a very volatile year. As I stand today, they're pretty much flat year to date, Bitcoin and Ethereum, down maybe 5-10%. But we are in the midst of a very uncomfortable drawdown in Bitcoin and particularly Ethereum. Ethereum tends to be more volatile than Bitcoin. That is certainly true. You can see that in terms of the red line here in Ethereum compared to the blue Bitcoin. It is more volatile. I would expect that to happen. But when these drawdowns happen, and they do happen very often in Bitcoin and Ethereum and crypto generally, it is very uncomfortable. And I talked the other day about one's belief set in the longer term in terms of the efficacy of both Bitcoin and Ethereum in the wider economy as digital gold and as the digital guardrails for the new economy. And though that belief set gets tested, but one has to keep a very firm eye on the longer term when one's thinking about crypto and try to put aside the volatility in this asset class. So flat year to date, not great, but not a complete disaster in terms of crypto, but it will continue to be volatile, certainly in coming weeks as well, I'm sure. Which brings me to gold. It's been a golden year for gold, up 55% as we speak, partly because of this. This is gold as a percentage of global international reserves. And you can see that central banks globally held back in the 1930s, 1940s, 80 to 90% of their reserves in gold, as opposed to currencies. That went down to a low of 10% and is now back above 20%. So central banks buying into gold and increasing the share of gold as a proportion of their reserves, not liking fiat currencies so much, too many dollars around, dollar tends to get debased. So reverting back to gold. And that's particularly true in what's now called, quote unquote, the global south, China, Russia, etc. They've been buying aggressively into gold reserves and are moving more and more into gold as a stable reserve currency, backing again for currencies as it used to be before 1971 and Nixon took us off the gold standard. So a return to the gold standard as a backing for these Asian, Latin American, and global south currencies. And you can see that here. These are central bank purchases of gold, led by Russia, led by China, India, Turkey. This is in the last 20 years. This has been accelerating, certainly in the last few years as well. So these global south countries buying into gold and using it as a base for their monetary system and as a potential replacement for the dollar. It's been an important structural backing for gold and why it is still doing so well. And you can see here over time, this is gold at the top right, compound annual returns. This is for the last 25 years. This is at a time when the S&P 500, the US equity market's done extremely well. You can see that down in the blue line, then silver, then bonds, then the US dollar. And you can see recently gold's done particularly well. But over that 25-year period, gold has done 10% per annum, S&P give or take 8% per annum, silver 8% per annum, bonds 4% per annum, US dollar, as you'd expect, flat. It doesn't yield very much. So gold has outpaced the best performing equity asset class that one can almost remember in the last decade or so. So worth remembering that gold holds its value against most things in the longer term. And you can see this in this chart in the last 20 years since the 1999 tech boom for the S&P 500. In gold terms, the market since then in the States, in gold terms, is down 70%. That's a remarkable stat when one thinks about how well the US equity market's done, and that's how we feel it's done. In gold terms, in very real terms, if I would put it that, it's down 70%. Quite remarkable. Big shout out for my friends in South Africa. South Africa is having a small moment in the sun. We're always volatile down here. But if you take a look at these charts in the last, 2 or 3 or maybe 4 years, our bonds, which is the green line, our equities, the green line in the middle chart, and our REITs, which is the property stocks, have done extremely well against their global comparators. Global bonds have done badly. SA bonds have almost doubled. Global equities have done well, but SA equities have done even better. So something's going right in South Africa despite all the volatility. So that was a quick shout out for my friends here. Okay, so that's markets. I'll wrap up on markets in a second, but I want to spend just a second on geopolitics in the last 10 or 15 minutes. Over the last year, China held its 80th anniversary of the Victory of China over Japan parade. And in that 80th anniversary, President Xi hosted President Putin, Kim Jong-un of North Korea, etc. in the most extraordinary military parade probably most of us would ever have seen if you did see it. A real display of strength from China, and China is clearly rising in all manners of the word, particularly in terms of its economy. We've talked a lot about this in terms of the pivot by President Xi into green economy and new economy areas. This shows you from the top left solar panel production, and then new energy vehicles, that's electric vehicles, and then bottom left service robots, and bottom right industrial robots. So by a long, long way, China is now the largest producer in the world of solar panels, 90% market share, electric vehicles, 60% market share, robotics, twice as many as the rest of the world combined. So these are the new economy areas which we're seeing all around us, and China is utterly dominant given its investment in that area. Oh, this is me meeting one of the new Chinese robots at the Singularity Summit in South Africa. This is the Unitary G1. I'm glad to say he was shorter than me because he was quite unnerving when I first saw him, but he became friendlier over time, or I became friendlier towards him, probably more appositely. So that's the Unitary G1. This G1 you can buy. This is the Unitary website. Unitary is the largest producer of humanoid robots in the world. The Unitary G1 goes for $24,000 US. You can ship him today or her today to help you around the house. Elon Musk's Tesla Optimus robot is coming down the pipe, but is not in production yet. It'll be a lot more expensive than this, probably $60,000 US. And so China is stealing a march, literally, in this robotics area. The cheaper version of the Unitary G1 is the R1, a barely believable $4,900 US for this humanoid robot who can do all kinds of things for you around the house. Again, available online for shipping today. And this is being backed by extraordinary levels of scientific and engineering spending in China. This shows you the government spending on scientific endeavor in the US on the left and in China on the right. And the spending cuts coming through in America now are reducing its scientific R&D budget from 45 billion to 30 billion, whereas China is increasing its from 35 billion to 42 billion. And that's the foundational bedrock for future scientific discoveries and the foundation for future success of China. And you can see here that now 8 of the world's top 10 universities for scientific publications are Chinese. Quite remarkable. And technology needs power. And China, as I've shown in terms of solar energy, wind energy, still increasing coal, but increasing renewables at a much faster pace. Nuclear capacity under construction. China is constructing or planning to construct, give or take, 70 new nuclear reactors in the coming 5 or 10 years. You can see that at the top of the page in terms of China. At the bottom of the page is the United States with 0 nuclear capacity under construction. So I wonder who's going to win that race. The United States has just signed a deal with Westinghouse to invest $80 billion into 10 nuclear reactors over the coming decade. But they're going to have to up the skill set in terms of the engineering prowess in America to actually build a nuclear reactor again. So China is winning that particular race. And you can see here, nuclear energy production in red in China has gone from really not very much at all to where it is today, which is about 10% of baseload from memory. Germany in blue, infamously or famously, has destroyed all its nuclear power capability and now produces 0 nuclear power. So a sharp dichotomy of approach to the crushing need for power, extreme need for power to power all the new economy sectors, particularly AI and robotics. And this is, as one other example of China, this is the Three Gorges Dam, which took a decade to build. It displaced 1 million people, tragically. But the Three Gorges Dam now, which produces hydroelectric power, actually slows the Earth's rotation by 0.06 microseconds. These are the new cities being built in China. They are farming cities. This is a rendition, I would say, but they are extremely efficient. Take 90% less water, can produce 9 times more food. This is interesting. You can Google this. These are drone swarms in China. This graphic is real. And these are thousands of drones, AI controlled, and they create lightscapes in the night sky in Shanghai, etc. here they are coming back to base. Again, China's the largest producer of drones in the world, in case you wondered. AI-enabled education in China. AI is now, I think, compulsory from the age of 6 in China. Children are issued with these large tablets, and they are AI-enabled. And so the whole education system is now based around this premise. Flying taxis, to talk about that. These flying taxis have now been authorized in certain Chinese cities. They're autonomous and flying, and you can fly around in them quite happily. And China's starting to project its power. I've talked about the Arctic last time, or previous time. This shows you the power projection of China in terms of Chinese vessel excursions through the Arctic Ocean in red. And they, along with Russia, are projecting their power into the Arctic Ocean, which is becoming more important as a shipping route, as well as militarily against the United States. And to finish, let's not forget the Middle East. Dubai is building its own mega airport, $35 billion, 400 gates, 5 runways, 260 million passenger capacity. Saudi's also building one. And the Middle East is definitely front-footing it now to seem as a whole in terms of an economic hub. Whilst Russia, as I speak, there is no peace deal as yet for Ukraine. It looks like the world is edging towards it, and part of that deal will be to bring Russia back into the global financial system, the global economic system, for better or for worse. I suspect that's what's going to happen. And Russia will retain and attain the whole of the Donbass, as well as Crimea, as part of that deal, and Ukraine will not be able to join NATO. And I suspect that'll be thrashed out in the next few weeks. So let me wrap up with a 5-minute run through of how did it go for 2025 in terms of, I guess, what I was saying and how it turned out. Some went well, some did not. Number one, I've been talking about a shift away from the United States in terms of market leadership. That has happened. Non-US markets doing better than the US, despite AI within the US. That's been a tick. Gold and silver, we talked a lot about that. They did lead the way, very much so in 2025. Crypto has done less well. We'll talk about that in a second. I did say AI would be huge, been saying that for some time, and it certainly has been. And a move away from a unipolar world to a multipolar world led by China. That's definitely happened. Ukraine peace settlement, question mark. In the Middle East, I said that Iran would be nullified, and that has certainly happened. With this B-2 stealth bomber strikes against its nuclear capacity. And Saudi would be positioned as the power broker in the Middle East. And that seems to be edging that way as we speak. And then Arctic tensions would rise, and I think that is happening a little bit in the background yet, but you may have seen some of that as well. What surprised me, certainly the extent of leadership of the Mag 7 in America. That's been extraordinary. And the extent of AI capex. Huge numbers going into AI data centers, and then the speed of delivery of humanoid robotics, particularly out of China. So in the sense that all those three are the fact that technology surprises you in terms of how quickly it comes along, both in terms of AI currently and robotics particularly. So to finish, what about 2026? I think these are maybe straightforward things to say. AI continues to explode. We are seeing on a weekly basis extraordinary movements in AI. I'll talk about that more in the new year. We'll all have an AI agent, or most of us will, or many of us will, if we choose to do so in 2026, which will run our lives if we choose to go that route. It will impinge on our lives in all kinds of different ways. Robotics is the next big thing, and AI, which is human intellect, and robotics, which is human labor. The combination of those two things will be transformative for the manufacturing chain and the service level chain and everything we do with our lives. AI stock valuations are looking a little frothy, but they are growing crazy fast. But I suspect they'll show a little bit more risk in the coming year. And I think investors will continue to look outside the United States for value, where markets are cheaper. And then I do think gold, silver, and crypto continue to be a sensible part of a balanced portfolio. And by the way, a balanced portfolio in the broader sense is the way to go always. A sensible mix of equities, bonds, cash, and other things, including gold, silver, and crypto. And I think that will continue to serve you well in the future. So I think that's it for 2025. I hope that's been helpful, and I hope you've had a profitable year overall, and I hope things continue to go well in 2026. So a good year overall, despite all the volatility, and let's look forward to hopefully a good year for the coming 12 months. Thank you.